In this video, I talk about whether you should invest in ETFs, mutual funds, or stocks. Ideally, like I reiterate in my videos, what you invest depends on your individual goals and risk tolerance. To help you decide what financial vehicle you should use, I'll be covering 3 categories in this video. The 3 categories are risks, cost and fees, along with return on investment, to help you decide which financial vehicle you should undertake. I'll start off with the category of risk. I'll start off with the lowest risk, gradually moving on to the highest risk. The least riskiest out of these options are ETFs. ETF stands for Exchange Traded Funds. So what happens is that you invest your money into a company, and what that company does is they pool your money alongside other investors' money and invest into multiple companies. Due to this high diversification, your risk decreases significantly, and this makes up for the lack of returns with ETFs. To showcase the example of ETFs being the least riskiest, I'll talk about the Aussie Top 200 ETF on the CommSec Pocket app. With this ETF, you get access to the top 200 companies on the ASX. Let's say, for instance, a random example, that 50 of them somehow go bankrupt, which is near impossible. You still have 150 companies with a small bit of ownership. The second more riskier option out of these financial vehicles are mutual funds. And many people get confused between ETFs and mutual funds. The goal of an ETF is to follow the market trend, whereas the goal of a mutual fund is to beat the market. With mutual funds, yes, you do see a higher yield based on your investment. However, it requires more research, and the fees for holding these are much higher than ETFs. The reason why many investors, such as me, prefer ETFs is because they follow the market, and historically the market has always gone up. Yes, there's been times such as now where the market's either going low or it's sinking or it's plateauing. Otherwise, it's always gone up and it will continually go up. Individual stocks carry the highest risk, as all your money is in one basket. That doesn't mean you shouldn't get individual stocks. However, that means you must be more educated and you must take the time to research what companies you're investing in, as if you don't research well enough, you're potentially liable to lose all your money. Now, the next category I'll be covering is the cost and the fees associated with holding them. Once again, leading the category is ETFs. ETFs are the cheapest option. The brokerage I use is the CommSec Pocket app, and through that, all I have to do is invest a minimum of $50 per trade, and I'll be incurred with a $2 brokerage fee for trades under $1,000. I have already done a review about this app, and if you're interested, I'll leave a link up here, so click on the eye icon. The maintaining costs for ETFs are around 1%. However, if you average out the ETFs in the CommSec Pocket app, you'll realize it's around 0.7-0.8%, which is not too high. This is also deducted from the ETF's daily price, so you won't notice. The next financial vehicle on this list are mutual funds. The reason why mutual funds are higher than ETFs is because of this active management fee. Unlike ETFs where you can let them go passively, there's someone actively managing your portfolio and trying to beat the market. Hence why you're paying 2 to 3%, and it depends on where you bought this mutual fund from. Lastly, we have stocks, and stocks have varying prices. In this video, I'll be talking from the perspective of the CommSec website, and the reason why I'm talking about the CommSec website is because they're easily the most used brokerage in Australia. Just as a side note, I don't want you guys to get mixed up between CommSec website and CommSec Pocket app. CommSec Pocket app is designed for new investors who want to invest a little bit of their money into the stock market, whereas CommSec is designed for people who want to invest in the long term. ANZ and the other big 3 banks also have their own versions to this. However, the reason why I like CommSec is due to their brokerage fees. The first trade must be a minimum of $500, and every other trade after that consequently must be a minimum of $100. And most people aren't up to investing $500 straight off the bat, hence why CommSec made CommSec Pocket app for those investors, where you can invest with little as $50. Now I'll cover the ROI category. I'll go from the greatest return to the lowest return. I'm pretty sure you guys already know which financial vehicle has the greatest return, and that is stocks. Stocks have the greatest return on investment if you know what you're doing. And if you do not know what you're doing, you're liable to lose a lot of money, as high reward also creates the high risk. The financial vehicle with the second greatest ROI out of this list is mutual funds, as they're designed to beat the market. However, like I iterated with stocks just then, the greater the reward, the greater the risk. ETFs have the lowest return on investment out of all the financial vehicles listed here. However, they require minimum or next to no preliminary knowledge. The goal of the ETF is to follow the market, and we know that this is a safe bet, as historically the market has always gone up. If you guys have a specific topic you want me to cover, please write a comment below. Otherwise, thanks for watching my video. I hope you enjoyed it and learned something from it. Please subscribe and click like, and thanks for watching my video. Goodbye.